Harish Krishnan joins us, the Co-CIO and Head of Equity with Aditya Birla Sun Life. Good morning, nice to have you back. How would you assess the market mood and the recent run-up? Is it liquidity or only liquidity which is making everybody just go crazy?
I think all of the above. If this is a multiple choice question, Nikunj, right? So it's. I mean, let's look at the context, right? We all know that India is a great structural story. The fact that the demographic dividend is there, the fact that we have a young population with aspirational income rising, all of them is pretty well known. I guess, if you were to look at, say, India's share of the world GDP, that's likely to be close to about 3.75% this year. India's share of the world market cap, as far as equities is concerned, is close to about 4.25%. So, while from a longer term perspective, this 3.75%, which is today's India share in the world GDP, is likely to go to 7, 8, 9, 10% over the course of the next decade and more. I think in the near term, clearly it is liquidity which is driving it. Now, why do we say so? I think one can all agree that, over the course of the last 3 months, we've got two key negative events which have played out. One is while the election verdict still gives a reasonable stable government, it still is a coalition government, not as per anticipations of what the market was anticipating. And we've also had some kind of a tinkering as far as capital gains is concerned. Market has seen through both of these walls of worry, climbed them quite comfortably. On the other hand, if you were to look at the corporate earnings scorecard, it is not painting a very great picture at this point of time from a near-term perspective. Of course, the longer term, we continue to remain reasonably positive out there. But from a near-term perspective, sales have started flagging off. Margins, which did extremely well in the whole of FY23, whole of FY24, is starting to come off, and therefore earnings growth is a bit tepid. So therefore, it does appear that liquidity is doing all the heavy lifting over the course of the last 3 odd months, and we have come to a situation where we do think that market should consolidate for a reasonable amount of time. Near term, in my opinion, is looking to be little unexciting for market participants, especially given the heady returns that most market participants now seem to anticipate over the course of the last 18-24 months that they have kind of seen.
Good and cheap in this market, and what is cheap and yet not good in the market?
Yeah, that's I think exactly where we come in. Which is primarily that, there are three dimensions in which one can look at this particular aspect. One is where earnings have not really, come through. And there is a potential that over the course of the next 3-4 years, earnings trajectory is likely to improve relative to the market. So that's one dimension. The second dimension is where the market is still worried about the near-term misses and possibly not able to see through that bigger term opportunity. And the third is where ownership is pretty much low. Now, if we were to therefore look at various sectors in that kind of a basket, we think that pharma still continues to remain reasonably good. As a space, while it is completely bottom up and heterogeneous, we think that earnings share is starting to move up quite significantly for the pharma sector as a whole. There have been meaningful cut in API prices leading to margin expansion. I think there is a reasonable amount of price erosion which has happened over the course of the last 4-5 years, which is kind of stabilizing. I think pharma looks still good in our opinion. Similarly, consumer durables. This is a space which, while in the last 6-9 months, thanks to a very harsh summer, has kind of seen a lease of wings. I would think that, over a 5-year period has not really delivered. Earnings still are meaningfully lower from the cyclical highs that they have seen in 2018-19 post demonetization, when margins really shot through the roof. Most of these companies have embarked on big capex plans. We all know that the real estate cycle started in earnest in 2020 post COVID, and almost all the keys are likely to get started handed over in 24-25. So I think consumer durables is another interesting space. The third bucket, which I would classify, would be sectors which, where the near term is actually not looking that great, but where we think that there is a prospect and a promise where market is kind of obsessing over the near term while missing out the longer term picture. I think IT is clearly one area where the near term numbers aren't anything great to talk about, but I think there is a significant prospect of both margins correcting for the IT sector upward, as well as demand coming through over a 3-year cycle. Similarly, metals today, of course, given global geopolitical situation and the softness in demand, people are anticipating worries on the overall metal prices. But again, Indian metal companies have kind of bolstered their balance sheet significantly. And this is a space where there is very little ownership on the street, which can see a leg up. Consumer staples, a space that we have avoided so far, is starting to look interesting as well. While there is a narrative that near-term consumption is soft, and clearly, in the budget as well, there wasn't any major sops given for bottom of pyramid consumption. We do think that the longer term prospects of this space look extremely good. So, and lastly, if I were to add one more sector, that would be cement. Seeing a massive consolidation, near-term pricing is a bit soft, but I think if one can look through the near term, these are the pockets where which haven't done really well over the course of the last 3 years. There is reasonable margin of safety in our sense, which is why we think that it makes sense to move away from those which have done exceedingly well over the course of the last 18-24 months. It's been a parabolic rise in many sectors. It makes sense to move into these kind of sectors, in our opinion, to play for the next 3-year cycle.
So Harish, construct a portfolio and what the diversification between small, mid caps and large caps should be for a risk-averse person and the one who is willing to take the risky bets, both in the medium as well as the short term.
So I think India is blessed with multiple sectors, multiple competent management across the market cap breadth. However, sometimes markets get a bit ahead of themselves. So when we do the overall numbers, if we were to look at, say, pre-COVID levels in 2019 till now, and we see the market cap accretion, for the top 100 companies, the market cap accretion is entirely explained by the earnings. In fact, they've seen a valuation derating. For the mid cap, close to about 67% of the market cap delta is coming from earnings, and roughly about a third is coming from valuation expansion. For small cap, it is 50-50, which means roughly 50% of the market cap accretion is coming due to earnings growth, and the rest is due to valuation increases. And in micro cap, it is almost 1/3 explained by earnings and 2/3 explained by valuation. Now, when we've seen such huge valuation re-rating lower down the curve, we do think that it makes more sense to go higher up the curve rather than chasing going down the curve. So the way we think is, we're not suggesting that if you're a really long-term investor, an aggressive investor, to shun all small caps or micro caps, etc. But what we would think makes sense is to go one level lower in risk curve, which means that if majority of your investments are in small cap, maybe it's better to move into mid cap. If it is in mid cap, it's better to move into large and mid caps. If it is in large and mid caps, to move into flexi cap, etc. I think that provides a sense that while we are not expecting a massive crash or a significant fall in markets, one can still keep participating in the longer term prospects of Indian equities without necessarily experiencing very sharp drawdowns that your current portfolios might kind of experience over the course of the next 1 to 2 years.
Right, Harish, great to have you on the show. Thank you so much for joining in with your opinion on the markets. Okay, that's a whole lot of view coming in on various sectors in the markets which are looking attractive right now, according to Harish Krishnan.